Hi, everybody. Welcome to our May 28th Member Connect webinar for the Marin Builders Association. My name is Rick Wells, and this is a picture of our Board of Directors. On behalf of our Board of Directors, welcome to our event. Also want to mention that out there right now and on our website are these two items, which are free COVID testing for all construction workers in Marin County, and we encourage you guys to take advantage of that. These posters and templates are available on our website. A quick review of our agenda. So John's not here, but I'm taking over. So this may go faster than to 2:07. Then we'll have a brief overview from Mike Blakeley and Rob Eyler, and then we'll adjourn at 2:30. It's going to be fast-paced and informative, and get you back to your workday. I'd like to add a quick but important thank you to our board of directors, many of whom are on this call, our cornerstone partners, our 560 plus member firms that are supporting our work today. Your support via your annual membership investment or annual sponsorship is helping us put programs like these together during these times of change and challenge. So congratulations on being back to work for nearly a month or more. As you navigate this new landscape of what work actually looks like these days, we are here to help. We've done so by working with local authorities and agencies to develop consistent, straightforward resources, posters, and signage for your job site. All are available at marinbuilders.com. Most are available in English and Spanish. Marinbuilders.com is updated several times a week with resources dedicated solely to operating a successful construction firm here in Marin County. Also, a recording of today's webinar will be posted on our site, along with the recordings of our past 4 Member Connect webinars. So before we introduce our speakers from the Marin Economic Forum, I wanted to mention that our partnership goes back with them several years when we commissioned a report that led us to these findings, which are on your screen right now, about the tremendous impact of construction on our local economy. As you can see, construction represents more than 10,000 jobs in Marin County and is a major economic force moving into the future. Our colleagues at the Marin Economic Forum also partner with us to deliver our Permit Customer Experience Measurement and Improvement Program, also known as our Permit Simplicity Program, aimed at helping to improve the permitting process across Marin. They've worked with us in San Rafael, Novato, and Tiburon, with more jurisdictions to follow. So with that, I'd like to introduce our speakers for this afternoon, Mike Blakeley and Dr. Robert Eyler. Mike is the CEO of the Marin Economic Forum, nonprofit organization here in Marin County. He's a senior economic development expert who has held several leadership roles in advising public and private sector clients. He's a Marin County native and lives here as well. And Dr. Robert Eyler is the chief economist for the Marin Economic Forum, PhD from UC Davis, BA from CSU Chico, and his family comes from West Marin and Sonoma counties, where they've been sheep and cattle ranchers since 1910. So with that, I will turn it over to Mike.
Thank you, Rick, and thank you everybody for having the Marin Economic Forum be part of your Member Connect series. As Rick said, we've got a partnership that goes back a few years now and hopefully more to come. One of the things that MEF does is monitor industry trends, and not just here in Marin County, but also outside of Marin County, make sure that our sectors here are informed about what's happening around the nation, around the region, in the event that there's any changes that they want to make or business model change, integration to do, those types of things. And so as it relates to the construction sector, I mean, we recognize that Marin is really a hyper-local market. You can't compare this to somewhere in Iowa, for example. I mean, some of the characteristics here is that we just don't have a lot of space to build. So maybe in the past few weeks, you've been hearing people talk about this rush to the suburbs, this what they call de-densification of urban centers. And that's something that it's not really going to happen in a place like Marin, because obviously there's not a place to put a bunch of residential homes. Housing is also a contentious issue here, as we know. And of course, some of the other things that we have here is an affluent population that likes to make luxury upgrades to their homes. And that's something that going forward, if we go into recession, we don't really know how that's going to affect everything. And then finally, I always like to recognize that from jurisdiction to jurisdiction, we have different zoning and planning policies, which makes it very difficult and timely, costly to really do the work. So those are some characteristics of the Marin construction sector that are very different than the rest of the country. And I'm going to come back to that in a second. Obviously here locally, the construction sector's fared okay through this in the sense that they were allowed to continue essential programs. And now as of May 4th, I believe it was, even non-essential construction projects could continue, and Rick already touched upon that. I've seen some other comments from North Bay leaders in the construction sector that there's been pent-up demand that they're trying to now fill. And so from some respects, and Rob may have data on this, the construction industry is set to, as we say, snap back maybe faster than others, with potential threats maybe seen down the road if we slide into a deep recession, and that cuts back spending on residential or non-residential construction. But I did want to share a few things that are going on around the country, which you may or may not be aware, but are of interest. I don't really know if these would take hold here in Marin, but you should know about them anyway. One of the things that's happening at a pretty accelerated pace is virtual inspections. And of course, I sit here in an office, not on a construction site, so I don't really know how feasible that is. But where I've looked, that seems to be something that a lot of municipalities are trying to adopt, not just as a workaround of the shelter in place, but even going forward as maybe something that may be more efficient. I don't really know how feasible that would be or desirable even by the construction sector, but it's something that is happening. And I can see a lot of ways where it would make things easy, but I could also see all the challenges. Second thing, obviously, there's a lot of new designs that are prioritizing less density, whether that's a bigger space in an apartment building or just fewer apartment buildings being approved in places. That's clearly a trend that's taking place, as is actually an increase in permit applications for low-rise structures. Again, this is on the national picture. I'm not sure how relevant it is here, but interesting nonetheless. And then finally, one thing that you're seeing a lot of, and this may be something that could be interesting here in Marin, is you're seeing repurposing of other non-residential spaces for health facilities, healthcare facilities. And as we know, we have a lot of commercial stock here in Marin County that's dated. Tenancy improvements are difficult and expensive to do here, but maybe if those buildings are repurposed for healthcare facilities, I don't know if that would fast track anything, but that's starting to emerge as a trend as well. So those are just a few things on the national level that I thought were interesting and wanted to share with all of you. Before I turn it back to Rob, I'll just point out a few things that we see as the threats. And again, Rob might expand on this, but as I mentioned, we do have this affluent community here, but and luxury upgrades have provided a lot of work for especially smaller contractors and subcontractors. It's really too early to tell if that segment of the market might decline as a result of recession or slower consumer spending, but that's something that should be on the radar. What I'm very concerned about are potential staff cuts in planning departments that would limit the ability or even slow down tremendously inspections, permit applications, all the types of things that you have to deal with on a day-to-day. There's nothing that suggests that jurisdictions aren't going to have to cut back their budget somewhere. Hopefully it's not going to happen too much in terms of planning departments, because that work is not only pretty busy now, but for the foreseeable future, it looks like it will be busier than other sectors that might need to be regulated. And then finally, MEF conducted this business retention expansion project just that we were wrapping up in February and March. And one of the biggest takeaways from that, no surprise, was that hiring is hard to do. We talked to plenty of contractors and construction firms that confirmed that for us. And although we go into recession and although we're seeing millions and millions of jobs being shed on a national level, the fact that there is this pent up demand and the fact that it was already hard to do to locate workers, and that it might be even more difficult to get those workers back because of safety concerns or whatever the issue is, there is a potential that hiring could again be a problem in this particular sector. So that's just an overview of some of the things that we observe, that we're looking at on the national level, here in the local level. But obviously our close partnership with the Builders Association allows us to get direct input from all of you, those of you who are on the ground. And we're going to continue to monitor the situation. And with that, I'm going to turn it over to my colleague, Rob, who's going to give you the numbers.
Thanks, Mike. I'm going to share my screen now. Let me know, Mike, if you can see this really quick with just a thumbs up once it's live. Awesome. Thank you so much. So, folks, I'm going to walk you through very quickly what we think is happening at the macro level and then bring it down to Marin County to try to show where we think construction might be going, at least in MEF size. The recovery from COVID-19 and the economic slowdown based on our sheltering in place is a combination of three policies. The first two are positive, monetary and fiscal. So interest rates have gone down. The Federal Reserve has been relatively aggressive in lowering rates again, just like it did at the end of the Great Recession. And we've seen a relatively large fiscal package come out of Washington with all kinds of nodes, household payments, business lending that might just turn into basically one big fat tax refund for businesses, and an array of other lending and other spending opportunities. And we're hearing some rumblings that there's more construction potentially to be funded by the federal government in terms of upgrades to infrastructure. We might see more of that as the year progresses. But the bottom line is that all that positive policy is beset against this negative of being sheltering in place and having our economy basically go into hibernation for a few months. Our emergence from that has started. As Rick said earlier, construction has started again. Mike talked about that there was always essential construction going on, and now a lot of parts of California and the United States have started back construction in full. I'll talk about in a minute the positives and potentially the slowness in which that's going to happen in terms of its effects on the greater economy in just a second, but it's very positive we finally got construction started again. Okay. One of the biggest data points we've been watching is weekly claims for unemployment insurance. And Mike talked about the millions of people who have lost their jobs. Well, one of the maybe positive things is that that progression is weekly in terms of how we're getting the data. And you can see the millions of people going on to unemployment insurance here at the US level, but you can see it's also peaked. The good thing about its peaking is that historically speaking, once these data have peaked, it tells that in a relatively short amount of time in the future, we should see the unemployment rate peak, because this is the genesis of new people going on unemployment and ultimately being unemployed. This slowly sliding down, especially once people start getting hired, will mean more people are going to come off the roll. And at some point, we will see our economy recover. This is the US data. These are the California data just over the last few months. So the speed at which this has happened is somewhat unprecedented. What that has turned into are forecasts for the economy going forward. And I'm going to show you some highlights of forecasts that are out there right now about the US economy to see a very quick dip down and then a slow emergence over the next few years. So the Philadelphia Federal Reserve every quarter surveys 40 forecasters. All these guys do every day of the week is forecast what's going to happen with the US economy. And the middle of that forecast is what I'm showing you here. For real GDP, or let's say real income or productivity in our economy, that second column in that shaded area is the new forecast for the next 4 quarters. So you can see the second quarter, the quarter we're currently in, is currently being forecasted at negative 32.2%. That's very large negative change in our economy. That's very similar to the Great Recession the Great Depression in terms of the magnitude. Now, the difference is that we don't have any of the same economic constructions as we had going into the Great Depression. So don't think that this is the Great Depression round 2. This is probably more like the Great Recession round 2, somewhat light, and hopefully avoiding the housing market problems. But what these data also show, if you notice the next 3 rows down, is that we get back to business relatively quickly. Those are unprecedented growth rates as well on the positive side. So these forecasters see the second quarter of this year being the worst of it, and then the slow emergence over the next few quarters and next few years to get back to where we started. The unemployment rate corroborates that forecast, where the height of the rise in the unemployment rate is likely going to be reached in the second quarter of 2020, and then we'll slide back down. But notice that slide only gets us just under 10% unemployment. We started this at the national level at just under 4%. Gets us just under 10 at the beginning of next year. And if you look at the next few years, it's a negative year this year in terms of productivity, and then relatively positive the next few years. But the unemployment rate does not get back down to what we could think of as sort of pre-COVID-19 levels until 2023 or maybe 2024. So thinking about that long slide means we're probably in about the same duration as the Great Recession, thinking 2011 forward, because it was about 2014 or 15 where things really started to cook. And we might have to wait 2 or 3 years to sort of reclaim what we're losing these last few months, believe it or not. Housing starts look like this over the last 3 recessions, and these data are actually from 1990 forward to just last month. The new data just hit the street earlier this week. You can see that wobble at the far right-hand side, and the reason I'm showing you this is because you think about housing starts as the beginning of new construction projects in housing, regardless of their being permitted or not. When they go live, that usually starts a lot of positive economic impacts in the economy. Notice that since the Great Recession, that third vertical shaded area in the middle of this graph, we've seen this slow and then more quickly rising pickup. The last few years have been a little bit wobbly, and we've kind of seen those in the data and know that on the street that the amount of housing that started has tapered off a little bit. But it was rising again, and Rick alluded to this as we were coming into this year, and now it's sort of wobbling around again. So we were watching very closely these data at the national level, and the second part of this is actually in the western United States, which is most of the West, basically the Rockies West, where California is the dominant player in that. But watching that closely is going to tell a tale about how confident developers are in starting projects, even if they are permitted. Now, in terms of a housing forecast, this is the latest forecast. These numbers also just hit the street on Monday that come out of Zillow at the county level. And you can see Marin is shaded in black to kind of pick it out, and then Sonoma is in red, and San Francisco is in green. But all these numbers are kind of around 2% negative. And this is from April 2020 to April 2021. So these economists are not seeing much change in housing prices, which is good. One question I get a lot is, are we on the cusp of Great Recession 2 in terms of seeing housing prices dip 35, 40% again? And the answer is right now, there's no economic reason why that should happen except for one, and I'll talk about this in more detail in a minute, and that is if the unemployment rate remains high and stays relatively high for a long period of time, and what an economist would call a structural change in the labor market, that could lead people who are currently in their homes as owners, who lose their job for a long period of time, not being able to afford to stay in their home, and then that could lead to some more volatility downward in terms of housing prices. But this is relatively mild movement in terms of historic recessions over 1 year's time with respect to housing markets. And that's because most economists believe that the housing market should be relatively untouched by what's about to happen, because supply and demand are going to follow each other relatively closely in this episode. Now let's talk about jobs real quick, and I'll come back to jobs in a minute. Here's the loss in US jobs from April 2019 to 2020, because these are the latest data we have on the US market. Notice that construction, which is about the fifth from the right-hand side, is relatively low. But here's California from April to give you some contrast. So the change in jobs in construction were a little bit larger than the change at the US level. And what that 14.5% means is 14.5% of the folks that were working in construction last April have now lost their job. So that's a little over 1/8 gone. Which, if you go to the far right-hand side and you think about leisure and hospitality, which are hotels, restaurants, and an array of attractions, that's almost half the jobs that were here last year are now gone. So in relative terms, the loss in construction is a little bit past the middle industry that lost jobs, but not as bad. And we had to expect that. A lot of construction sites had to shut down, and a lot of interior work had to change in the short term, but that may start to come back. And that's one of the keys, is what are the indicators for that comeback to happen? And there's construction highlighted again for the US and California. Well, who cares about all that macro data in the end? Well, let me break down why you should care. One is a lot of what I just told you is going to shape the expectations of homeowners, developers, and governments in terms of moving projects forward. Interest rates going lower should help. Equity markets using those expectations and being positive. The equity markets have been on maybe what you think is kind of a counterintuitive bounce back from lows. But as long as that remains relatively high, people won't have a negative wealth effect because they've lost money in the market that would maybe keep them from a project starting. So that can also help support demand. The longer duration of unemployment, as I alluded to earlier, could be a sag on demand. And any shifting structure, especially on the commercial side, if we lose a lot of retail, if we lose a lot of restaurants, if hotels have problems, then the development of new hotels, restaurant and retail spaces might be slow or very focused on just remodeling over the next 2 years, maybe even longer, because there's a lot of structural change happening in that industry where developers don't necessarily want to build more on spec, that industry is going to start to suddenly burgeon. So we're watching that very, very closely in terms of what happens on the commercial side, because if there's one industry that has more threat than others, it's probably going to be on the commercial construction side versus the residential on the front end. Okay, So with all that said, let's now quickly talk about what to watch locally. So let's now transition. The graph I just showed you about jobs, I'm now going to repeat the California numbers, which are here. And now let's look at Marin County and Sonoma County. As Sonoma is our largest neighbor, we want to think about in Marin County what that might mean and further where the problems might lie. So you can see construction, which is outlined right there, had some relatively heavy losses and slightly heavier than the state. But Marin County and Sonoma County reacted differently than other parts of the states. For example, Solano County kept construction open the entire time. They haven't changed it one bit. So the employment level on construction there barely slowed down, which was good for Solano County. What's been good for Marin County potentially is that the amount of money that might now pour into these projects, if the wealth effect remains in place, and if a lot of people have kept their jobs that would normally put in or have projects demand, then you will see hopefully some growth there. And these numbers are just the beginning of the tough time, and we will relatively quickly come out of it. We will see. But just like California, if you look to the far right-hand side, leisure and hospitality and personal services, the sort of array of our downtown structures and a lot of our mall structures are going to see a lot of job losses, and that can easily change the structural aspects of demand in commercial. If we look at construction jobs more focally, here are the losses by the trades. So heavy construction, which makes sense because those all kind of stayed in place as essential construction, didn't lose that much at all. There was some slow downturn in the number of the amount of hiring, probably as we were just starting to get used to a different environment on the job. But a lot of the other jobs we've seen lost so far from last April are mainly in interior projects and in contractors that would otherwise be moving machinery around on projects that probably got stalled. So if we make the corner, or we turn the corner relatively well, coming back to these projects that stopped and then will now restart, or projects that were permitted that will now start, that's going to help everybody get back to work. And that's key. So watching these indicators over the next couple months will tell a large amount of the tale as to whether or not construction A is getting back to work and what resources might be remaining in Marin County to keep the momentum going into 21 and 22. Okay, so to look at a more aggregate level, this is the evolution of Marin County construction employment from basically the end of the 1990s forward. And the real way to look at this is the following. You can see the dot-com recession on the far left-hand side, then the Great Recession in the middle, and that deep dive we took in construction employment here. And it looks like on the surface we're going in the same direction. But the difference here is that slide in construction employment in the Great Recession was over, believe it or not, almost 2 years of time to get from start to finish. This might be about 2.5 months of time. So that speed might lead to something that's a little more speedy coming out of it, because at the bottom of that shaded area, there was an enormous amount of policy, lower interest rates, fiscal spending, just like we're doing now, that came to bear on it. And then there was almost like a V-shaped recovery in construction. We might see something very similar because the economic conditions, after everything has been sorted out of the Great Recession, are very similar now as they were 2009, 10, and 11. Let's look briefly now at California, and you can see California basically following that since the bottom of the Great Recession and going down along the side of Marin County and really just driving the entire state down as we're going into this first round of ugly data. Okay, to wrap up, folks, there's going to be changes. Assume that in construction, things like this are going to start showing up. Robotics doing repetitive framing work or something like that. There's going to be larger developers who are going to wonder whether or not this is the play if I'm going to have a bunch of people sick on the job and I can make this investment now. I know that sounds scary, but this is a prototype, and assume there's going to be some movement out there. That's maybe on the negative. On the positive, there's going to be a complete change in the way we use our homes for some industries, and we might have a lot of interior construction demand and remodeling demand to convert what otherwise would have been a play space or, let's say, a study into an actual business functioning office, because I'm going to need that to work from home. And I'm also going to need to be able to watch my kids at the same time. So there might be a lot of, repetitive and maybe smaller, but at least a lot of them projects. If we think Marin County is a place where a lot of people could potentially bring their jobs home, and they're going to be doing that on a more regular basis. In terms of land use, how we look at building is going to change. As Rick and Mike both said, the momentum we had coming into this, we had a lot of discussion about housing crises and how we were going to see building going forward. Will we want to live in as densely populated an area anymore? And is that going to delay projects maybe until the middle of this decade once we sort all this out, get a vaccine, kind of get to a new normal? we will see, because a lot of planning around housing and new units were going to be more tightly packed, more maybe condo style next to transit. This is where a lot of the governments around California and the California government itself wanted to see housing evolve. That may not work now on the demand side, and that's going to keep developers relatively nervous about continuing with plans that look like this. Another piece on the commercial side to watch is on the mall side. What are we going to do with our malls? If malls start to see a lot of vacancy, are there ways in which we might see construction demand come in to reorient those spaces for tenants that actually want to go into the mall space for two major reasons? One, for example, a restaurant who otherwise won't be able to work outside in the winter might find a mall space with some tenant improvements, giving them flexibility to move into the interior of the mall space and have it covered for 12 months a year. That's something different than, let's say, a downtown in San Rafael space that will move out during when the weather's nice, but won't have that option if those protocols are still in effect come more inclement weather. So we'll see how that plays. But be watching how land use and some of the debates to come in terms of zoning and some of the project debates that we had going into the end of the last decade change maybe because of COVID-19 going in toward the middle of this decade. Finally, let's talk about the public sector. There's a lot of consternation. Rick talked about a project that MEF and MBA are working on in terms of trying to figure out ways in which we can simplify the permit processes. Public sector has got to become a bigger partner with construction to keep the momentum going. The economic impacts of construction are large, and governments know that. There's always a lot of political friction about building, but I think what we're going to see is with people moving home, there's going to be a lot of want for somebody who would never come and get a permit anyway, now to convert my office space or my part of my home into an office space, and I might need a permit for that. And they might get a lot of people who otherwise would not want to see construction growth, or let's say the permit process be relatively less difficult to wade through for political reasons, now say, you've got to streamline this because I need to get this office space dealt with. We'll watch for that very closely. And the other thing on the public side is how we educate potential workers in this industry. That's something that's dear to my heart, and I'm watching very closely how we're going to transition to something that maybe is a more hybrid environment, especially for those we train to go into the trades. So folks, to wrap up, watch the labor market closely. That's where a lot of this is going to show up, in the sense the more workers we see hired, it's probably coming on the heels of demand. We might see a lot of residential construction in ways we never thought possible. Commercial real estate is probably going to go through some wackiness over the next 12 or 18 months minimum, and there might not be a lot of new construction in retail and restaurants, part of that, or maybe in office, because there'd be a retraction of having people work from home. But we might see more in industrial, because we're already at relatively low vacancy in industrial, and that might be where construction and commercial finds its way home. That remodeling piece, where are local residents going to go if they start to put their houses up for sale? So the cool thing about the housing market forecast is that we probably won't see a lot of price change, because rental vacancy is still relatively low. And if people are going to sit in place, we should see supply and demand walk together. And then finally, folks, it's how we lift up. So be thinking more about 2021. We'll probably have a pretty decent year this year, but that momentum needs to continue if we're really going to climb out of this, completely have a recovery. So I'll hand it back over to Rick now, and thanks a lot for having me today.
Fantastic, Rob. Thank you very much. Always a pleasure, and amazing that you're able to cram that much into like 22 minutes. So with that, I would like to say thank you to Mike and Rob Eyler. Thanks to everyone for joining us today and spending some time connecting with us. Remember, all of our resources, including our posters, templates, and all of our webinars are posted at marinbuilders.com. Please stay safe, stay healthy out there. Thank you for your support of the Marin Builders Association and the Marin Economic Forum. Thanks.